Hi folks, and welcome to this video on provisions. I decided to include a few questions on here because from time to time we do get students who get a little confused or mixed up with provisions. So I just picked a few different examples for you here. And what I want you to do is to state if a liability should be recognized, and if so, I want you to calculate it, make the entry to record it, and if you can't calculate it, state how you would calculate it, but if there's no entry, tell me why. So let's look at the first one. It says here on January 2nd, X8, the mining company began operations and they had a contract, and part of the contract was to remediate the mine site, which really means to put everything back the way it was before they started mining. So if they upset the land anyway, they had to make sure that they put the site back in the same condition that they found it in. Now, it said there that they would do that when the mining was complete, but that would likely be in 10 years. So the company's estimating now that that cost in 10 years' time would be around $420,000. And the market rate of interest, or ACE's incremental borrowing rate, is about 6%. So the first thing we need to determine is a liability even recognized? And the answer is yes, there is. The reason is because they have a contract. And under the terms of the contract, they are obligated to remediate or put back the site in the condition that it was in. Okay. Sometimes we also see these kinds of things. If there's not a specified contract, there might be a government obligation that says you might, or maybe it's an environmental rule that says you must. So as part of the condition of using that property, maybe the environmental laws would dictate that you need to remediate a site. So these are all examples of terms and conditions that require you to set up an obligation because you know that you can't avoid it at the time you're going to have to pay it. So in this case, what we'll do is, because we're not going to pay out any money until 10 years' time, we do know the company's borrowing rate, we're going to calculate the present value to estimate the liability. So in this case, we'll use our calculators. And don't forget, your P/Y would be 1, and you'd have 420,000 as your future value. Your yield is 6. 10 years is the time at which you think you're going to have to make a payment. Now don't forget, your PMT is 0 because you're not making any annual payments here at all, or any semi-annual payments. It's not like a bond. So your PMT is going to be 0. So if you compute PV, you get 234,526. So you're going to credit the obligation, or the provision, to remediate the mine, to remediate the remediation obligation on the mine for 234,526. And don't forget, this is part of the cost of mining, and all the costs related to the mine go into the asset account, which would be a mine. All right, so this is your long-term asset, which is your mine. Now, the second example here has a company, and this company, Y34, guaranteed a $10 million loan of another company. It says here that there is a 40% chance that $10,000 will have to be paid by Y35, and we need to record the obligation. Why? Because this is what we would refer to as a loan guarantee, and all loan guarantees are going to be valued at fair value. So how do we calculate fair value? We take the likelihood of payout, which is 40%, and we multiply it by the amount of the guarantee. So there's a 40% chance that we're going to have to pay out on that loan. We don't know if we will or we won't. It's 40%, but we set them all up at their fair value, or their expected value in this case, which is 40% times the amount of the guarantee. So now we record the obligation at $4 million, and what we would do is we would set up a loss due to the loan guarantee, and this would be an unusual item on your statements, your income statement, and credit a provision for a loan guarantee, and that would be $4 million. Now, our last example of a provision that we have here is a lawsuit, and I know for some students these ones are a little bit more challenging when they have probabilities involved, so that's why I picked it. It's similar to one we did in class, but I've just switched up the numbers. It says here we have one lawsuit, so again it's only one suit, so we have a small population, and the customer made the lawsuit for $950,000. The legal department thinks there's a 20% chance that the claim will be dismissed in court. So if there's a 20% chance that it's going to be dismissed, it's likely that there's going to be a payout, right? So the company offered to make a settlement offer of $750,000, because even if there's a 20% chance that it would be dismissed, there's an 80% chance that there's going to be a payout, right? So right away, you know, because it's more than a 50% likelihood of a payout, because like a payout is probable at over 50%, we have to set up a provision. So whenever you're looking at provisions, you have to look at what's the likelihood of payout. If the likelihood of payout exceeds 50%, then you got to set up a provision. We know that's the case because there's only a 20% chance that it would be dismissed in court. So if it went to court, you'd likely have to pay. 80% chance you pay. But the company is going to try and make a settlement. Well, even if they settle out of court, it's still a payment that's being made. So you still got over an 80% chance that you're going to have to pay something out. So again, got to set up a provision. They're going to make a settlement. Their settlement offers for $750,000. The legal department thinks that there's a 45% chance that they're going to go for it and accept it. But if not, it's going to go to court with a 20% chance of dismissal, and they think there'd be an 80% chance of a payout, and that payout would be for the full amount of the suit. So, payout is likely, we've already discussed that. So because it's a small population, again, we said it down here, it's a small population, we have to accrue it at the best estimate. The best estimate is the most likely outcome. The outcome with the highest probability is the most likely outcome. But we also have to temper that calculation, or that amount of the most likely outcome, by thinking about the expected value and any cumulative probabilities. Here we don't have to worry about a cumulative probability. Why? Because there's only a 45% chance of settlement, and if it's no settlement, it goes to court. 55% chance it goes to court. So there's no sense in doing a cumulative probability. So we're going to have to look at the most likely outcome informed by expected value. And why do we say look at the MLO, or most likely outcome, informed by anything, expected value? Well, what if your most likely outcome is too small when you calculate the expected value, right? Sometimes students tend to think that whatever the most likely outcome is, we just calculate the expected value and take that number. Not all the time. You have to look at the most likely outcome. So in other words, take the outcome with the highest probability, and that likelihood, whatever the amount of the payment would be for that likelihood, take that. But if that's too low, you may have to go higher. So that's why you have to calculate an expected value or a cumulative probability. In this case, cumulative probabilities don't make any sense. But we can calculate an expected value. But what we say here is you have to use combined odds. When we talk about combined odds, we're really talking about this section down here. We know there's a 45% chance that we're going to settle this out of court, right? So if we don't settle it out of court, that means there's 55% chance that we'll go to court. When we get to court, there's a 20% chance it'll be dismissed. So in total, out of 100, there's an 11% chance that it'll be dismissed, or 20% chance of dismissal, based on a 55% chance that we might go to court. If we go to court, there's an 80% chance, or a 44% likelihood, that we'll have a court payout. And we know what that will be. We think that'll be more like $950,000. So now, here's what we would do. We would say, well, our most likely outcome is 45%, because 45 is bigger than 11 and bigger than 44. So we would say, well, the most likely outcome is a $750,000 payout. But is that so? Let's look at the expected value. So we're going to take 45% times the 45% is the chance of settling out of court, and if we settled out of court, we think we could settle for $750,000. If we went to court, 44% chance, we pay out $950,000. If the court dismissed it, if it went to court and it was dismissed, that's 11% chance, we'd pay out nothing. So if we do the multiplication in the brackets, add them all up, we're going to get $755,500. Now notice, that's bigger than 750. Now if it was material, it's not that much bigger, but it's still bigger. So, but say it was extremely bigger, like, 875,000 or something like that, then we definitely pick this, no question. But they are close. But the safest thing to do is to pick the expected value. So although more information about the success of the settlement offer should probably be obtained before the statements are issued, because we don't really know if they're going to accept this offer or not. So we're not really sure, but it doesn't really matter. In this case, what I would suggest is you make an accrual and set up a provision based on 755.5. You can use professional judgment. Some accountants might say, well, for $5,500 when I'm dealing with a base of $750,000 is really nothing. I can set up what I want. But just to stay true to the rule is you'd use the most likely outcome, but if there's a difference and the expected value is higher and the cumulative probabilities are higher, then, to stick true to the rule, you would pick 755.5. So I'm going to set up the likelihood here for the provision at 755.5, and the loss due to litigation, which would be your debit. And again, if you don't have legal suits often, they would be unusual items, and they would be in your income statement in the unusual items section at 755.5. So this concludes our short review on provisions.